Good morning. Welcome, everybody, to our December webinar, Philanthropy and Charitable Giving. And today, our presenter is Chuck Vickery, the founder of Vickery Financial Services, which is now Elevate Wealth Advisory. Good morning, Chuck.
Good morning.
Thank you so much for joining us this morning. And you have given this talk a few times before. It's always a fan favorite. As we wrap up this year, so many of our clients are trying to figure out what to do at the end of the year when they're giving to their favorite charities. And this is always one wonderful talk to explain the process. So I'll let you take it away.
Well, it's mid-December. The days get shorter. Our to-do list seem to get longer, and just seems like we don't have enough time. And last month we talked about year-end planning, which covered a lot of different things. And this subject, philanthropy and charitable giving, also has a lot to do with year-end planning, but it also has a lot to do with planning next year as well. So I want to talk a little bit about get good from doing good, because when we share our resources, we touch, change, improve, impact, and provide for other people, other institutions, things that we care about. So that's what we want to talk about today. And giving may make you more prosperous. I know it makes you feel better. There's actually 3 dimensions of wealth. And you've got to remember, wealth is Old English for well-being. So those 3 dimensions are the financial, the personal, and the social. So ask yourself this question: if I had more time and more money, I would. What would you do if you had more time and more money? So there's only 4 things we can do with our wealth. We can spend it. We can give it to our heirs. We can give it to our favorite charities and institutions, or we can give it to the IRS. And nobody ever likes or selects voluntarily number 4. They'd rather give it to anybody other than them under normal circumstances. So let's talk about some things we can do other than spending it and giving it to our heirs, and maybe even get the IRS to help us a little bit. The tax deduction is important, but most people give for altruistic reasons. That's the real core and the real reason that people give. Tax savings comes in second. It's nice to get the tax savings, but people don't give money to institutions or charities that they don't care anything about, tax savings or no tax savings. They give it to institutions that they care about. So let's talk a little bit about the tax deduction. Prior to 2017, when the Tax Cut and Jobs Act was passed, it was pretty easy to itemize. Single people, it was a little over 6,000, couples, mid 12. And then the Tax Cut and Jobs Act was enacted, and all of a sudden our hurdle went from 6,000 for single to 12, and from 12,000 for couples to 25,000. And if you're over 65, those hurdles are even higher, almost $14,000 in 2021 for singles, and right at $28,000 for married couples. And the list of itemized deductions was dramatically whittled down. Over 52 things were taken away that historically we could itemize with. So because of that, we're starting to see more and more people take the standard deduction. And when you do that, you may not, when you take the standard deduction, you do not get credit for your charitable gifts. So let's talk a little bit about this. So we want to go over 3 giving strategies. One is how to turbocharge your donations. One is donor advised funds, how you can bunch up donations. And one is qualified charitable distribution. So let's talk a little bit about those. When you're deciding how much and to whom to contribute, consider all the options. Yes, you can always give cash. And actually in 2021, under the CARES Act that was passed because of the coronavirus, you can now give away 100% of your income. That's not a good strategy. It's not smart because we don't want to get rid of those 10% and 12% brackets, but you can. So you can give cash, but also you can make non-cash contributions that can reduce your taxes, increase your charitable contributions, and maybe be a smarter way to give. So if you gift appreciated assets, stocks, mutual funds, real estate to a charity, it's done by you simply transfer the asset to the charity. The appreciation on these gifts is not taxed. You don't pay taxes on it, and the charity doesn't pay tax on it. So there's no capital gains tax on it, but you do get full credit for the gift. Now, this is limited to 30% of your adjusted gross income. If the gift is larger than 30% of your adjusted gross income, you can carry that on your next 5 tax returns. So how does this work? Well, recently, I had a client come in and they were giving $600 a month to the church. So that's $7,200. They're in a 24% tax bracket. So for every dollar that they gave to the church, it cost them $1.24. So it was $8,900. And it was, is it deductible? If you qualify, it's deductible. If you don't qualify, if it's not above that $25,000, then no, you don't get to write it off. You take the standard deduction. So the amount of the deduction would be $7,200, even though it cost them $8,900. So when you go buy groceries, you buy milk and bread and cheese, those dollars have already been taxed. When you give money, you write a check to your charity, those dollars have already been taxed. And whether or not you can deduct it depends on other things at the end of the year. So I was talking to him and I said, look, you've got some mutual funds that have appreciated pretty substantially. Why don't we transfer $7,200 of mutual funds? And for every dollar they gave away, it cost them 34 cents. So a $2,400 investment by them a few years ago had turned into $7,200. So we transferred the $7,200 to the church rather than the $7,200 in cash we gave mutual funds. Nobody paid any tax on that $7,200. And if they're able to itemize, they get full credit for the $7,200. And I did this for a client 3 or 4 years ago, but it was about a $50,000 or $60,000 gift. And the numbers looked a lot like this. It was costing him about $10,000 or $12,000. And he said, what does God think about this? And I said, well, I think God likes this, that you're helping the church. Why don't you ask your preacher? He said, that's a great idea. So he called me back the next day and he said, I talked to my preacher and he said, it's fantastic. That's a great way to do it. So this is just a way to the dollars coming out of your pocket or less. A lot of people will take that $600 a month that they've been giving the church and add it back to their account to replace the $7,200 they took out. And then if they need the money in a year or 3 years or 4 years, their cost basis is higher and the taxes are dramatically lower a second time. So that's one way to do it. Another way is with a donor advised fund.
What is a donor advised fund? A donor advised fund, or a DAF as they're also known, is a charitable investment account that can only be used for making gifts to charitable causes. When a donor opens a DAF, they're able to irrevocably transfer assets such as cash, publicly traded stock and mutual fund shares, closely held S Corp and C Corp stock, residential and commercial real estate, agricultural commodities, life insurance policies, oil and mineral rights and royalties, or precious metals to fund their charitable giving. Those assets and their value are held inside the fund until the donor is ready to make charitable grants to their favorite causes. A donor is able to advise the fund to make grants in the amounts and on a timeline of the donor's choosing. The charities receive a check from the fund just as if the donor had made a direct donation. Donors like using donor-advised funds at American Endowment Foundation for the following reasons. A DAF at AEF provides some of the best and most immediate tax savings available. When a donor makes a grant to a charity, they can receive as much recognition or privacy as they may desire. At AEF, your donor-advised fund can be passed down to future generations, allowing a donor to build a family legacy of philanthropic giving. The value of the fund can grow tax-free, providing more assets available to fund charitable gifts. Your financial manager can remain involved, overseeing the assets in the fund and providing the consistent investment guidance that you have come to trust. Contact us to find out if a donor-advised fund is right for you.
So that happens to be from the American Endowment Foundation, which sponsors donor advised funds, but Schwab has them, Fidelity has them, other people have them. And DAFs or donor advised funds are like many private foundations without all the headaches and the cost that a foundation has. And it allows the engagement of multiple generations. So a lot of people are making gifts. And let's just say you're giving $5,000 to your charity every year, and you're taking the standard deduction. Well, again, you're not getting credit for that on your tax return. But what happens if we bunch up? Maybe we say, why don't I put $30,000 or $40,000 in a donor advised fund, and then add in my property tax and my state tax and my mortgage interest on top of that, and get a big deduction this year. And then over the next several years, take money out of my donor advised fund and give that to my favorite charity or church and take the standard deduction. And a lot of people are doing that. And it says it allows the engagement of multiple generations. So you can involve your children, and you can actually have it so that when you're no longer capable of making gifts out of this, you can make your children the successor grantors, and they decide which charities go to it. So I involve my girls in this whenever we're making gifts, because I want them to get used to giving. I also want them to have thank goodness my girls get along great. But I want to make sure they have an opportunity to talk every year about gifting. And this is a program where they can give money and they can talk about who they want to give to. So donor advised funds are a great way to give money. And when you put money in, the first one I ever did was about 20 years ago, and the guy never took any money out of it for about 15 years. He named it after his parents, and he put in a relatively modest amount, and over 15 years it was invested, and it tripled in value. So there's no requirement that you have to take the money out. You don't have to do it annually. You can take it all out in the first year. You can take out just bits and pieces. Normally there's a minimum $250 or so if you want to make a grant or gift to a charity. So you can use it for the Boy Scouts or the Girl Scouts or the United Way or your church or Sandy Creek Nature Center or whoever you want, university, whoever you want to give it to. You do get a deduction in the year that you make the contribution. And it does go into an investment account. You can keep it all in cash if you're going to give it away shortly, or you can invest it very aggressively if that's what you want to do, because you're not going to use the money for several years. But by bunching up your contributions and making this donation, you can get a nice tax deduction. And you can turbocharge that, just like that annual gift, by taking appreciated assets, stocks, mutual funds, and real estate. Even if you've got a business and you're selling that, you can even put shares of your business in it, which gives you a giant deduction. So that's a way to even turbocharge a donor advised fund. But for many people, they're a great way to give money and get a tax benefit from that they normally would not receive. In December of 2019, the Secure Act passed, and there was two there were a lot of provisions, but there were two main provisions. And we started talking about those in January of 2020, and in February of 2020, COVID hit. So we sort of backed off and started looking at other things. Two things that it did that's important is, one, it changed the required minimum distribution age for retirement accounts from 70 and a half to 72. So this gave everybody an extra 18 months where they could let their money grow before being forced to take withdrawals. But a strange quirk to it was that it left qualified charitable district contributions from IRAs, and these have to come from IRAs. They can't come from 401ks or 403bs or 457 plans. They left the qualified charitable contribution age at 70 and a half. So once you reach age 70 and a half, you and or your spouse can each make a contribution to a qualified charity, which is a 501c3, of up to $100,000 per year from your IRA, and you do not include that charitable distribution as income. It does count toward your RMD. So why would you do this? Well, if you do this, a lot of different things happen. One is it lowers your income. And so that's important. But also you don't have to pay tax. It excludes this contribution from your income, and it allows you to take the full standard deduction. So let's just take a look at somebody that's got an IRA. They're giving $5,000 to the church. So they have the IRA send them $5,000, and then they write a $5,000 check to their church or their charity. So the results are the charity gets $5,000. The $5,000 withdrawal helps satisfy your required minimum distribution. However, that $5,000 is reported as taxable income to you. And if you're in a 24% tax bracket, when you file your taxes, you get to pay $1,200 in taxes. So that's the way that it would be done maybe prior to 70 and a half. But once you hit 70 and a half, you can do a QCD, qualified charitable distribution. So what happens here is you request your IRA write the check directly to the charity. Now they can send it to you so you can deliver it to them, and a lot of people like to do that. The results here are the charity gets the $5,000. The $5,000 still satisfies part of your required minimum distribution, but the $5,000 is excluded from your income, your taxable income, and the tax bill is zero. So instantly doing this saves you $1,200 in taxes if you're in that 25% tax bracket. So it's a great way to give once you get to be 70 and a half. And we utilize this extensively throughout Elevate with our clients. At least we let them know about it. Some people are good givers and some people aren't. And the ones that are good givers and that are 70 and a half need to utilize this. With a QCD, you exclude taxes on both the gift to the charity and on the standard deduction. So you get both. Both reduce your modified adjusted gross income and your taxable income. And the reason reducing your modified adjusted gross is important is because what you pay for Medicare is determined by your modified adjusted gross income. So if we can keep that below the IRMA income related monthly amount and pay a little bit less for our Medicare, that's even better. So QCDs are a great way to give. So there are four ways we transfer assets: by beneficiary, your retirement plan, your life insurance, your annuities, all that beneficiary; by ownership. So if you have joint ownership with right of survivorship, maybe your checking account, your home, with a living trust. Beneficiary, ownership, and trust all trump the will. What goes through the will is what is not passed by beneficiary, by ownership, or by trust. I told you there were two big changes in the Secure Act, and one was that Now the retirement age is 72, rather our required minimum distributions are at 72, not at 70 and a half. The other thing that the Secure Act did for basically non-spouse beneficiaries for your children, where they used to be able to inherit your retirement account and spread the taxes out over their lifetime. Now there's a 10-year window, and that account has to be emptied in the 10 years. So how do you do that? Do you take it all up front and pay the taxes? Do you wait till the 10th year and let it grow and hope it grows enough to pay the taxes? Do you take out a little bit all along? How does that work? Well, it depends on individual situations, and we're discussing this with people. But anybody that dies after January 1st of 2020, their beneficiaries, their children as beneficiaries, are now going to pay tax on that money sooner. So we talk about transfer the right asset, die with the right asset, and how this comes into play with charities is if you plan to leave money to a charity at your death, do it as tax efficiently as possible. We had an example of a client that came in and he put 2 charities in his will, and each one was to get 5% of his total net worth. And we got to looking at it and we said, hey, why don't we change your will and exclude these charities in your will, but go to your IRA. Remember, there's a beneficiary on an IRA and that trumps the will. Let's go to your IRA and leave a percentage of that to these 2 charities. And here's what happens. When you die, the money, there's a step up in basis. So your assets other than retirement accounts, your heirs can sell those and not have to pay any tax on it. When your heirs receive IRAs, they do have to pay tax on it, but the charity doesn't. So we could leave 50,000, 100,000 to a charity through your IRA, and they get it totally tax-free. And then leave those assets that are outside of the retirement account, not to the charity, but to your heirs, and they will receive those tax-free. So it's just a lot smoother way of doing things, and it's a lot easier. And you just think about you personally. You'd rather inherit something that was tax-free rather than something that was taxable. So do some planning, and if you want to support a charity, look at different ways to do that makes sense for you and for your family. So in summary, there are 3 smart ways to make charitable contributions: gifting appreciated assets, utilizing a donor advised fund, and then doing qualified charitable distributions from an IRA. Which is best for you? Well, talk to your advisor. Talk to, if you're not a client, call us and we'll sit down and discuss it with you. But your advisor can tell you which is best. And a lot of it has to do with the value of your assets and your age, and whether you have IRA accounts or non-IRA accounts or both. But we'll be glad to discuss that with you. So, and we'll talk to you before the end of the year, but think about this for next year, and you may want to come in and talk before you make any substantial gifts early next year and just see if there's a better way to do it. So that pretty much is what I've got. If we have any questions, Betsy, I'll be glad to do my best to answer them.
Very good. If anyone has any questions, feel free to type them up in that chat box you see down at the bottom of your Zoom screen, or else there's also a Q&A box, and you can put that in there. I did want to mention to everybody that we do have an article up on our blog that our advisor, Rob Fazekas, just wrote about last minute tips for year-end planning. And it does go into some of the things that Chuck talked about today about gifting. So Chuck, a married couple, it looks like from Rob's post, the married couple can give up to $30,000 to each of their children in 2021. Is that right?
That's correct.
Okay. And then tell us about that form that you have to fill out if you are filling out any lifetime gifts or for tax exemption.
Okay, well, when you do estate planning, we all have a lifetime exemption. It's in the high 11 millions right now. That's probably going to be changed soon. In 2025, the law expires, and I think it goes back to 4 or 5 million. So you can give a lot of money right now. The 15,000 that you can give to anybody in the world, and your spouse can join you and make a $30,000 gift to anybody in the world. And we give those normally to children. I always tell people my last name is Vickery, Vickery. If you want to make a check out to me, feel free to do so. And nobody's ever taken me up on that. But if you want to give more than $30,000, you can fill out a gift tax form. And let's just say you gave somebody $100,000, help them buy a house or something. Then you would fill that form out, and the 30,000 would be the 2021 gift. The 70,000 would go against your lifetime exemption of the $11 million. There's no taxes due, but your $11 million exemption just became a 10,930,000 exemption. So if there are opportunities where you need to give more than the 30,000, feel free to do so. The other question I get a lot about that is who pays tax on these gifts? Well, a gift is like a Christmas present. If somebody gives you a shirt or a blouse, you don't pay tax on that. And if somebody gives you money, cash, you don't pay tax on that. The gifter paid the tax. Now, we talked about gifting appreciated stock to a charity, and you avoid paying capital gains tax on it. If you gift appreciated stock to other people, your cost basis goes with it. So if you've got an asset that's appreciated from $1,000 to $10,000 and you give that to a child, when that child sells it, it's still worth $1,000. Their cost basis is $1,000, and everything above that is subject to capital gains taxes. If they inherit that asset, then it steps up in basis and they can sell it and not pay a penny's tax on it. Or if they hang on to it for years, the only tax they pay is the appreciation since your death. That's a long answer, Betsy.
No, that's a great answer. It's very thorough. What time of year do you think it is best for people to really start thinking about their end of the year? I know that a lot of times we don't really think about it until it's about December and it's time to wrap up the year. What time of year do you recommend that people really take a look at this so that they're not scrambling at the end?
We see a lot of activity pick up when school starts back. And the reason for that is people say, I'm going to do this next year and I'm going to do that. And then all of a sudden school starts back and it's August or September and they realize, wow, I haven't done anything I wanted to do. I need to get on it. And the year's getting by. So September, October gives you enough time. It's even better to do it earlier. So you sort of know what's going on. One of the worst things I can think of is living off non-retirement money and then in December taking your required minimum distribution. I would take my required minimum distribution if I was taking it lump sum relatively early in the year, and then supplement that with non-retirement money. And that way you can control your taxes a little bit better. But Thanksgiving and Christmas are great times to talk about giving with your relatives, with your children, with your grandchildren, and asking them if they have a favorite charity and letting them know that you've got this donor advised fund that we can take money out of, or there's foundations you can set up, but you normally need probably north of $2 million to make one of those really feasible. and there are other ways, but just, Thanksgiving's a great time because we're thankful for things. And what are the institutions we're thankful for? And what are the institutions we want to support? But you can also do that at Christmas. Because Christmas is the spirit. It's not the giving, it's the spirit of the season that's so important.
So do you have to give by December 31st, or can you do it a little bit into the next year and count it as your 2021 contribution?
You have to give it this year if you're going to count it this year.
Okay.
Now, what you might want to do is, again, if your mortgage interest, if you have a mortgage, and your property tax, your state income tax, and your gifts are just falling short of the standard deduction, maybe what you want to do is wait until 2021 or 2022 and give your 2021 money to your charity, and then before the year is out, give them the 2022 money. We're bunching that up. And that's what a donor advised fund does. It just, let's look at what we're going to do over the next 4, 5, 6 years and put all that into a pool so we get a big deduction this year.
Fantastic. Well, that wraps up all of our questions today. I know we had a couple people join us a little late, so I wanted to let you know we have recorded this video. We're going to put it on our YouTube channel, and I will send a link out to everybody who's here today so that you have a direct link to Chuck's presentation and you can share it with any friends and family you feel might benefit. And then if you want to go back and look at any of our other webinars from previous months, that's all on our YouTube channel. And the best way to find that is just going to our website at www.elevate-wealth.com. And you'll look under resources and events, and you'll find all of our webinars there. We're going to be making some changes to the website this year that will make it a little bit easier to find those webinars. But then you can also bookmark our YouTube channel, and you can look at all of our past content there. Please feel free to sign up for our 2022 webinars. We're going to be kicking it off on January 25th with key changes to your financial data in 2022. So any key financial changes to tax brackets, anything like that, David Jenkins will go over that in January. I hope everyone has a wonderful holiday. And Chuck, thank you so much for spending your time with us today.
All right, Merry Christmas, everyone.
Bye.